I want you to try to think of a country that spends more than it earns and imports far more than it exports. This government runs huge deficits, its trade balance is deep in the red, yet its currency is strong, its debt is in high demand, and for the most part, the world still sees it as one of the safest places to park their money. Well, if I didn't give it away, that country is the United States. For decades, we have appeared to defy some pretty basic rules of economics. Let me explain. We all know that the US government spends more than it takes in through taxes, but it also imports more from other countries than it sells back to those same countries. Respectively, these are known as the fiscal deficit and the current account deficit, and right now, both are massive. Despite these imbalances, the US dollar remains strong. Global investors still buy US debt, and ignoring the uncertainty around these tariffs, there's no substantial rush for investors to exit American financial markets entirely. This seems to go against everything we're taught about economic stability. Back in the 1980s, economists coined the term twin deficits to explain how government overspending and trade imbalances were linked and potentially dangerous if ignored for too long. But if this idea is so important, then why hasn't it broken the system yet? Well, here's the core idea. When a country borrows a lot of money to fund government spending, it often leads to higher interest rates. Higher interest rates attract foreign money, which strengthens the currency. The stronger currency makes imports cheaper and exports more expensive, which hurts the trade balance. That's how the two deficits, the fiscal deficit and the trade deficit, are thought to be connected. But as I already mentioned, the US has been running both of these deficits for decades without a crisis. So what gives? Well, let's get into it. But first, if you find this video helpful or insightful at all, please hit that like button below and subscribe to the channel. Alright, back into it. So the twin deficit theory took off during the Reagan years. In the early 1980s, the US government cut taxes pretty aggressively while simultaneously boosting military spending. This caused a massive surge in the budget deficit. At the same time, the trade deficit widened. This wasn't just about rising consumer demand for foreign goods, it was also a product of major shifts in the global economic landscape. The US was transitioning into a more service-based economy, while countries like Japan, Germany, and newly industrialized economies in East Asia were ramping up manufacturing and exports. Advances in global trade networks and supply chains made it easier and cheaper to import goods, while the strong US dollar made those imports even more attractive. Meanwhile, the surge in government spending and consumer confidence fueled domestic demand that outpaced domestic production. The result was a widening trade gap that mirrored the budget shortfall, a pattern that helped crystallize the concepts of twin deficits for a generation of economists. But economists were still looking for answers. One model, called the Mundell-Fleming framework, became the go-to explanation. It suggested that when a country increases government spending under a system where the currency is allowed to float, meaning the market decides its value, it ends up raising interest rates. That draws in foreign money, pushes the value of the currency up, and causes the trade deficit to grow. Let's break that down a little bit. A floating exchange rate means your currency's value goes up and down based on supply and demand, not on a fixed rule or a peg to an asset like gold. And open capital markets mean investors are free to move money in and out of a country with few restrictions. So according to the model, if you crank up deficit spending, you're likely to get both a fiscal deficit and a trade deficit, which is a double whammy. This became known as the twin deficit hypothesis, and for a while it seemed to track. But over time, that connection started to unravel. In the late 1990s, during the Clinton years, the US actually ran a budget surplus, but the trade deficit stayed high. Then, after 2008, the government ran massive deficits again, but the trade gap didn't grow at the same pace. So what changed? Well, one explanation is globalization. As emerging markets, places like China, India, and Brazil grew, they saved more than they spent and invested that extra money in US assets. These are economies moving from low income to more industrialized and modern systems. Their savings flowed into the US whether our interest rates were high or not. In other words, the US didn't have to lure money in with higher returns. The money came looking for safety and stability, even if that meant low yields. But over time, economists realized the story was more complicated than just interest rates and exchange rates. There's a deeper structural connection between deficits, savings, and trade, and it changes how we understand the twin deficits today. Economists often talk about the identity that ties together national savings, investment, government borrowing, and the current account. It goes like this. The current account deficit equals the difference between national savings and national investment. If the private sector isn't saving enough and the government is borrowing heavily, the country has to make up that difference by borrowing from abroad. In practice, that means that the US trade deficit exists because Americans don't save enough and the government spends more than it collects. Another way to say it is that if private savings were higher or if government spending were lower, the trade deficit would shrink. But because consumer saving and business investment are relatively flat, any government deficit almost automatically results in a trade deficit. If neither households nor businesses are putting money aside and the government is running a large deficit, the gap has to be filled by foreign capital, which results in a trade balance. This is why efforts to fix the trade deficit through tariffs or currency manipulation often miss the point. You can't fix the trade balance without also addressing the saving and spending behavior that's driving it. A 2021 IMF study covering 33 countries found that for every dollar of fiscal tightening in a large economy like the US, the current account balance improved by 30 to 50 cents. That shows a pretty strong link. So if the goal is to reduce the trade deficit, you have two options. 1, cut government spending, or 2, boost private savings. Anything else is just a waste of time. But one huge reason that the US can get away with all of this is the special role of the dollar. The US dollar is the world's reserve currency, which means that other countries hold it in large amounts as part of their official reserves. They use it to trade oil, buy goods, and settle financial transactions. According to the IMF, around 60% of global currency reserves are held in US dollars. This gives the US what's called an exorbitant privilege. It can borrow more at lower costs for longer periods because everyone wants the dollar. And the safest way to hold dollars is to buy US Treasury bonds. But that creates a strange paradox known as the Triffin dilemma. To supply the world with dollars, the US has to run a trade deficit. But doing so too aggressively can eventually shake global confidence in the dollar. Liquidity is key here. That's the ability to buy or sell something like dollars or government bonds without moving the price much. Global markets need US liquidity, and the US delivers it by running a deficit. It's like a store that never runs out of inventory, but the cost is racking up credit with every sale. So far, no other currency has seriously challenged the dollar's position, so for now, the system holds. Now, it's important to note that not everyone buys into the twin deficit hypothesis. Some economists, especially those in the modern monetary theory camp, argue that governments that borrow in their own currency can't actually run out of money. What matters is inflation, not deficits. According to modern monetary theory, if inflation is low, you can borrow and spend as needed. Others point to what's known as the global savings glut. That's when countries like China and Germany save way more than they spend, and all that extra cash has to go somewhere. Often, it ends up buying US bonds. So in this view, America's trade deficits are a side effect of other countries' surpluses. Also, financial flows today don't always follow simple patterns. Sometimes a country with strong finances will see its currency fall. Sometimes a country running a budget surplus still has a trade gap because it's flooded with foreign investment. Capital moves for a lot of reasons: returns, safety, currency expectation, regulation. And when we're talking about this, timing is everything. Changes in government spending may not show up in trade data right away. And austerity, which is when a government cuts spending to reduce debt, can shrink a trade deficit, but it usually slows down growth too. All of this points to one thing. While the twin deficit theory has its flaws, it still highlights an important truth. Imbalances don't just vanish. They just shift from one part of the economy to another. For years, it's kind of seemed like the twin deficit hypothesis has lost relevance. But today's macro environment is reviving some of those old concerns and making the theory feel somewhat timely again. In 2023, the US ran a federal budget deficit equal to 6.4% of GDP. The current account deficit stayed above $900 billion. Meanwhile, interest rates are rising, and the Federal Reserve is tightening monetary policy. And while the dollar remains dominant, some traditional buyers of US debt, like China, are reassessing their exposure. At the same time, US borrowing needs are growing fast. The Congressional Budget Office projects that publicly held federal debt will exceed 100% of GDP within this decade. All of this is happening in a world that's changing rapidly. Global trade is fragmenting quickly due to tariffs, geopolitical rivalries are reshaping alliances, and former surplus countries are now running deficits of their own. So the point of all this is that the structural forces that once allowed the US to run these twin deficits without consequences, cheap capital, eager buyers of debt, and hyper-globalized economies, they're starting to shift. And as those forces shift, the feedback loop between government borrowing and trade imbalances may start to reassert itself. The trade deficit could become more sensitive to fiscal policy. Foreign demand for treasuries could become more conditional. In other words, theory isn't just making a comeback in theory, it might be coming back in practice. While the twin deficit hypothesis might not give us a perfect answer, it does offer a useful way to think about risk. In a world that's getting more complex, both economically and geopolitically, it's worth asking how much longer the current setup can last. Because the more debt we take on, and the more we rely on the world's appetite for US dollars, the tighter the rope becomes. Deglobalization, meaning slower global trade, more protectionism, and fractured supply chains, could put new stress on the United States' position. And if confidence in the dollar ever slips, the result could be quick and painful. Because in the end, deficits, whether fiscal or trade, are reflections of how much a country saves, spends, and invests. If we want to fix one, we have to take a look at all three. So the big question isn't just whether the theory is right or wrong. It's whether we're paying attention to the warning signs or brushing them off simply because the system hasn't failed yet. Thanks for watching, and if this video helped you in any way, please consider subscribing and hitting the like button below. It means the world to me. And until next time, have a good one.